This morning on the Ag Issues program, a pleasure as always to bring back to the program Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. Doing just fine.
Well, let's get right into it. And then, of course, the House passed their version of the budget reconciliation bill this past week. Party line, basically a party line vote. No big surprise there. Several hurdles they had to get through as far as the committees are concerned, but they got it into the full House. They got it passed, but there's a lot of things to talk about there. Well, let's first start with what we see as far as the key tax provisions that are contained in the House-passed budget reconciliation bill.
Yeah, this is a very important bill to avoid a major tax increase that will be coming in 2026 after the sunset of current law, Tax Cuts and Jobs Act, the Trump tax cuts of 2017 that took effect in 18, many of which will expire at the end of this year. So it's a very, very important bill. And again, I'm impressed with the House Speaker, how he's able to negotiate this and maneuver this all the way through the House with the different factions and so forth, and hold things together with the slim margin that he has. I told a group last week in Illinois that I was speaking to that it's just been amazing on several things that I thought would fail, that he's able to get it through. And I think last week it helped that President Trump came back from his Mideast trip, a very successful Mideast trip, and looked like things were not going well. And then about a day or two later, here it comes. So I think the president and the House Speaker really got their heads together on this, and impressions were made on people to either vote or hold a vote, or hold back their vote, just vote present to get this thing through. Because, and particularly for our farmers and ranchers, it's absolutely critical on several points, and I want to review those. But what this does is it keeps the current tax brackets in place, the same 7 tax brackets that we currently have, and that's really important for the lower end of the tax-paying scale out there. That avoids a 25% bracket rate increase for those, a married couple making about, I'll just round these brackets off, from 25 to 95,000. They would get a 25% rate increase next year if this bill doesn't go through. That was baked in the equation. That would be draconian. Plus, if these people had small children that could qualify for the child tax credit, then that child tax credit would get cut in half. It would go from $2,000 per qualifying child to $1,000 per qualifying child, and your standard deduction would get cut in half. So you'd start taxability at a lower level. Your rate would go up dramatically, 25%, and your child tax credit would get cut in half. So you'd see a massive tax increase, for example, for that single mom that's got a couple of kids or 3 kids at home underfoot that are age 17 and under. She would have gotten absolutely hammered, or will. This still isn't done. It's got to get through the Senate. And that's what I'm not sure people understand, is that the Trump tax cuts were heavily favorable to the lower end of the income scale. And in fact, it took a lot of people off of the tax rolls on the low end. And that includes farm people too. And so that's a big one. So this includes the same 7 tax brackets, the same casualty loss limitation, which means if you're going to have a casualty loss to be deductible, it has to be tied to a weather disaster, a weather-related event, a presidentially declared disaster area. Now that's tougher than where we were prior to TCJA, but it keeps that one in place, eliminates the miscellaneous itemized deductions, and keeps that rule in place. And of course, what Congress did was they doubled the standard deduction in essence and then indexed it. But in return for that, you lose a lot of miscellaneous itemized deductions, and you eliminate the personal exemption. So there's some trade-offs there. But for the vast majority of people, particularly on the lower end of the tax-paying scale, the TCJA was very beneficial, and this continues that.
And there are many things. One, estate and gift tax exclusion would be a big one in this, and especially for farmers too.
Yeah, that's been a question that I always get, and I don't think there's a seminar that goes by that I don't. When I'm talking to farmers specifically, they're really concerned about this because without the TCJA, the current essentially $14 million exemption would go back down to $5 million. It'd be indexed for inflation, so it'd be in 2011 dollars indexed, and that would be about, I think, about I would project it about 7.15 million from the current 14. So in essence, cut in half. Now, 14 million may seem like a lot, 7 million may seem like a lot, but at 7 million, that still picks up quite a few farming operations. Obviously, a lot more than 14 million does. It's a big issue. And if you just think of farmland, let's say you've got 1,000 acres of land, and let's peg that at $5,000 per acre. So we're substantially there on our 7 million. Then you add in livestock and machinery and equipment, a house, life insurance, all those things. You're easily up over 7 million for just a normal size, what we would think in Kansas as a normal size, average size farming operation. And you get out in western Kansas, of course, the farms and the ranches get a lot bigger. Now the value per acre is not as much, but on a relative scale, you still got a problem. You don't have a problem at 14 million. So what this does is it takes the 13.99 is where the basic exclusion amount is right now, increases it to 15 million starting next year, and then indexes it for inflation starting in 2027. So we don't erode that $15 million base out of there. That's a very big one for agriculture. And one other thing, Greg, before we get off of it, on the standard deduction, it also throws an additional $4,000 in for seniors age 65 and up. So they could add another $4,000 to the standard deduction. Now, that's the way that's handled on the return would be we currently have one for blind and other people with other types of disabilities. This is a $4,000 one for seniors. So you take your standard deduction, add $4,000. Now that's got a phase out on it. That starts to phase out at $75,000 for a single person, $150,000 on a married filing joint return. So for just put it in real terms, for people with modest income, before you hit the phase outs, this could easily be $500 to $1,000 lower tax just because of that increase in that standard deduction. And for other people, it could be a little bit higher, but that's for seniors 65 and up. The other hang up on the deductions, Greg, is the SALT deduction. And this is going to be a hang up on the Senate side. I'm pleased they got it through the House. There was some wrangling that had to be done, and there were some adjustments that had to be done. But the SALT deduction is the deduction you can claim on the return for state and local taxes. And this has been in the media a lot. A lot of the Democrats in the high tax states, particularly in the Northeast, you throw in Illinois, you throw in California, where they have high taxes at the state level. This is a big deal because there hadn't been a cap on this. And the Trump tax cuts put a $10,000 cap on this, and the big one would be for mortgage interest deduction, and you're capped at $10,000. And that can be a huge deal in some of these high-tax states. We don't think of that too much as an issue here in the Midwest, Iowa, Nebraska, Oklahoma, so forth. But you get in these high-tax states, that's a big deal. And so they negotiated in the House to take that $10,000 cap to $40,000, but phase it out for taxpayers with an adjusted gross income of starting at $500,000. I think that's going to go up in the Senate. I've already seen some significant discussion on the Senate side. A lot of the Democrats want that removed or taken up to at least $80,000. I know the president has said he's comfortable with $80,000, perhaps $100,000 on that, and that may solve it. So we'll see what the negotiation on that point is. But that's been a big deal. Now, associated with that has been what's known as the pass-through tax workaround, where you create basically a partnership and you run this through a partnership and then you filter it back on your return. It's more complicated than that, but that's essentially what it is. So it's known as the pass-through tax treatment on this. And that technique would be eliminated if they increase this SALT deduction significantly. Then that workaround, which Kansas allows, would be eliminated. So that's going to be perhaps a sticking point on the Senate side, but we'll have to see. That's a big one.
Excuse me. One quick thing here, too, because it may not affect the farm families directly, but it may affect their children if they have jobs outside of the farm. And that, of course, is the no tax on tips and no tax on overtime.
Yeah, let me clarify what no tax on tips and no tax on overtime means. It doesn't mean it's exempt from tax. It means it's a deduction. So you still have to include the tips, you still have to include the overtime amount in income, and then you back it out. You take it as a deduction from income. Now, there would be some qualifications, and these are only good 2025 through 2028. So if they get this passed and don't change it, this would be in play on the 2025 returns. But it's good for 4 years, 25, 6, 7, and 8. Include that income on a W-2, put it in there, and then back it out as a deduction. So I think what they're doing here is they're saying, all right, we know there's a lot of this tip income. It's just cash. It's not getting reported. So if you want a deduction, you're going to have to report it, and then you're going to back it out on your return. So that's done that same way for overtime. Now, there are also restrictions on the overtime also, and the overtime one is not an itemized deduction, so you wouldn't even have to itemize your return to get it. So those are a couple of big ones, and you can throw in the exclusion from tax on Social Security benefits, too. Now, that one's an exclusion. So unless this changes on the Senate side, those are brand new. Those are not currently in the law. Those would be brand new.
Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, is joining us. And Roger, the second major thing that happened last week was the anticipation of the Make America Healthy Again Commission report, the MAHA report that came out, 69 pages in length, and a lot to digest there. What were some of the things that you looked at or that stood out for this report?
Well, I think some key statistics in that report are absolutely critical. I see a report that says we've got a 1,400% increase in antidepressant prescriptions among young people over the past 20 years. That's just incredible. It's sad, very sad, but incredible. 250% increase in ADHD prescriptions between 2006 and 2016. 3 times as many children are obese as compared to the 1970s on a percentage basis. 75% of eligible young people can't qualify for the military, largely because of obesity. And then more than 40% of American children have at least one chronic health condition, and that percentage has gone up dramatically since the 1970s. Now, many of those problems are likely linked. Of course, obesity leads to sedentary behavior, which leads to depression, which then leads to being medicated. So it's a vicious cycle. And if you remember, Greg, some of the younger listeners probably don't remember this, but I remember when I was in elementary school, it was JFK's presidential, I forget the term that was used, Presidential Council on Fitness. I don't know if you remember that or not, but there was this Council on Fitness, and we actually did things in elementary school that were designed to improve fitness. And that kind of dropped out of the schools. And, of course, RFK Jr. is a nephew of JFK. And so this has been something that's really been important to him for decades, is to increase fitness. And he's an example of that himself. And so that's one. And they go through, in the 69-page report, a number of things talking about how to correct that and what they're focusing on. I think another key aspect of the report, Greg, is the focus on what's in the food that we eat. And this is going to be particularly a concern to agriculture, big agribusiness. You can anticipate, and I've seen it already, a pushback from what we call big ag, or what is called in the media big ag, the non-farm press big ag, about this. And there is the start of a movement to label food products so that consumers can clearly understand what's in the food that's purchased and what also, now we have labels, but in addition to that, what that label means for health when the food is consumed. And really, I think this is a tremendous opportunity for farmers, particularly smaller operations. So if the ag production system can be changed to incentivize rather than regulate the growing of healthier food all the way from the farm to the table, that could be an incredible boon. And we also saw last week, kind of simultaneously with the release of the report, commentary from Ag Secretary Rollins about new programs for small farmers, trying to incentivize the food production from small farms. It's not tied into this supply chain, big agriculture, the way we produce food, heavy chemicals, those types of things. To me, that's encouraging. If that can pick up, then we've got, instead of ag subsidies subsidizing heavy production in the major commodities, corn, soybeans, wheat, those types of things, you get further incentives to small farmers to produce in local production, and then you get away from the type of production agriculture that we have and the heavy processing of foods, where a lot of the health benefits are actually removed from the food that we eat. And that's kind of the focus of the report. So I'm not sure ag should be terribly critical of this, but understand that this was coming. This has been decades in the coming in terms of what the production system was headed for. And in my blog article that I put out on this, I talk about a path forward here and some of the legal issues that are involved that I'd like to also see change corresponding with this report. They weren't necessarily talked about in the report, although they're hinted at. But I elaborate on that in my piece.
By the way, just a little brush up on the history. President Eisenhower established the President's Council on Youth Fitness in '56, and then JFK, after that, of course, he was the next president, also looked at the same thing, and I'm still trying to officially find the name on that, but it was one that he basically took the ball from President Eisenhower and made it his own as well.
So it goes back further than I thought.
Yeah. So
yeah, good. Good.
So with the MAHA report, where does this go next with regards to, there's probably public comment that's coming on this, and then I understand, and correct me if I'm wrong, that there's going to be a second, maybe more comprehensive or, comprehensive or maybe even next step report.
Yeah, that's my understanding also. We'll go to hearings on this, public hearings on this. They'll solicit input from the public, and so this is agriculture's chance to provide input, individuals' chance to provide input on this. There'll be hearings, and then it'll lead to further report and then implementation, whether that's regulatory or by statutory fixes by the Congress later on. So this is the initial step, kind of opening up the issues here and getting discussion out on the table, which is a good thing. I don't think ag should be opposed to that. We want to have our products that we produce be healthy for consumers. And I think what I'm seeing here, coupled with what Secretary Rollins did last week, are some real opportunities for smaller operations going forward.
I want to also go back quickly over to the tax side of what we're seeing. You had a couple of more points we wanted to talk about. One is the qualified business income deduction that is taking place, but a specific point you wanted to mention.
Yeah, the QBI deduction is a 20% deduction on your business income. So anything that you manufacture, produce, grow, or extract gets a 20% deduction. So that's huge for farming operations. If I have, for example, $100,000 of production income from my farm, I get a 20% deduction on that. That's a $20,000 deduction right there off my taxes. So depending on what tax rate I'm in, is going to give me the final value of that on my return. That 20% changes to 23%, and the deduction is made permanent. That's a big deal. And then, of course, bonus depreciation goes back to 100%. We're currently at 40%. We're in the middle of a phase down, 40% this year, 20% next year, and then zero. That goes to 100% retroactive for property acquired after January 19 of this year. And that goes through January 1 of 2030. So it goes through 2029. And that's a big one. Plus an increase in the expense method depreciation amount, essentially doubling it up to $2.5 million. So the depreciation provisions are very important to farming operations. Those are absolutely critical.
And here we are almost into the month of June, Roger. We still have to get it through the Senate, and depending on how many changes there are, going through conference committee. So almost 5 months done through the year and still several steps yet to go before the end of 2025.
Yeah, Greg, but they're way ahead of pace. This is so much better than having a reconciliation bill come just before Christmas or even in January of the next year, which they have done in the past. So from a tax standpoint, we're really encouraged about this because we may actually know what the rules are going to be by the middle of the year rather than waiting at the end of the year. And of course, if you do it at the end of the year, then the IRS has trouble retooling their forms and getting the system set up. You get delays in the filing season. So, yeah, it may seem that here we're closing the fifth month of the year. We may not have it signed until July 4, which is the president's goal. But in terms of the way Congress has operated in the past, they are way ahead of schedule, and we do appreciate that.
All right, sounds good. Roger, as always, very much appreciated on a very busy week last week. Thanks, and we'll talk to you here in a couple of weeks.
Thank you, Greg.
That is Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, as he joins us on the Ag Issues program here on 580 WIBW.